Good morning, everybody, and welcome to the Managing Credit workshop for Butte County Library's REACH program. My name is Jacob Arbogast, and I'm going to be walking you through today's topic is managing credit. Every Friday, we do a personal finance topic workshop as part of the Butte County Library REACH program, and we cycle through different topics. We've done previously investing topics and personal finance topics and things like New Year's resolutions, financial related New Year's resolutions, those kinds of things. And so today's topic is on managing credit. And so a quick introduction about me, about our program here. So my name is Jacob Arbogast. I'm the director for the Financial Wellness Clinic at Chico State. The Financial Wellness Clinic offers financial planning information for students and faculty and staff on the Chico State campus, but we also do things like this, workshops and events and financial wellness and financial literacy topics for the general community as well. If you want to reach out to us for financial information, our email account or our email address is financialwellness@cscchico.edu. And so without any further ado, we'll get into the presentation. Some housekeeping things to be aware of is if you have any questions, you can ask them out loud if you're comfortable doing that, or if you post in the chat, you can send a message to everyone or directly to me. And what I will do is if I receive any chats during the presentation, I will not read the name of the person. I'll try to protect your privacy a little bit, and I will not read out your name out loud. I will just read the question so that everyone here can hear the information and learn from it. This video is being recorded and it will be posted to our YouTube channel afterwards so people can go back and watch it as well. So just keep that in mind. If you do unmute yourself and ask a question out loud, that's fine, you can do that, but just be aware that that will then be on the recording and that'll be posted on YouTube. So I just want to make sure that's really clear to everybody, but you can always feel free to post a question, just type it into the chat and then you would not be recorded. It would just be the question and then my answer to the group. So that's that, and we can move on to some credit topics. So today's topic is going to be about credit, credit reports and credit scores, how to build credit, some things, some information about fraudulent activity on a credit report and identity theft, bankruptcy, all the different areas that surround credit and borrowing and loans and all the things in our lives that come within those topics. And so first thing I want to do is just kind of give an intro for the people who are maybe new to this area and haven't been thinking about credit so much, or maybe just have an idea like I need to build my credit, but I don't really know how to go about doing that. So the first thing is credit exists so that if you are looking to borrow money for a purpose, it could be to borrow money for a car loan, or a house, you have a mortgage, or just to get a credit card. There's a lot of reasons that people might want to borrow money. But the people who are lending the money want to be careful. They don't want to just give out money to anybody, right? They want to have some reasonable assurance that they're going to get paid back, and generally get paid back with interest. And so credit scores exist so that lenders can get a sense of how likely is somebody to pay me back if I lend them money, and do they have a decent history with borrowing and repaying on time. And the full amount asked for, or at least the minimum payments. Those are the kinds of things that having a credit score would help a lender to understand about someone. So sometimes credit scores can be kind of intimidating, right? If you're kind of new, if you're maybe younger, or you just don't have a lot of history with credit. But it also provides some good opportunities, because if you can build a good credit score, you have an opportunity to get a better interest rate. Sometimes lenders will choose interest rates for loans based on your credit history, and they may, let's say you have maybe not so good of a credit history, your credit score is kind of low, but it's not so low that the lender says, well, we don't want to lend to you, right? If you had a 0 credit score, you didn't have any credit history whatsoever, then a lender might choose not to lend to you. But if you have like a medium level credit score, and we'll talk about the range in a minute, but let's say you had a credit score like in the high 600s or maybe the low 700s, a lender might not say no to that. They might not say, oh, well, that person doesn't have any credit, because you do have credit. It's just not the highest level. And so they may say, in exchange for lending you somebody who has not as good of a credit score as we want, but in exchange for lending to you, we were going to charge a little bit higher rate of interest on your debt to make up for the fact that we're taking a little more risk than we'd like to, right? And so if we're going to take a little more risk, we're going to, in exchange, ask for some more return as the lender from you, and so you have to pay a little bit more. It might mean a higher interest rate, which means your monthly payment will be higher there. But then that's just the, kind of the price you pay for having a little bit lower credit score. We'll talk about ways to increase your credit score, but if you get into higher levels, credit scores go up to 850. We'll talk about that in a minute. But if you get a higher credit score, then your interest rate can be very low. And nowadays, at least at the time of this recording of this video and this presentation, interest rates are historically fairly low, but will be going up in the near future. The Federal Reserve has announced that they're going to be increasing interest rates starting in March of 2022. And this is currently February of 2022. And so that should be happening pretty soon. And the market, you can already kind of see, is creeping up a little bit in preparation for that. Who knows what will happen in the future? It could be that interest rates end up going very, very high. In the past, in the 1980s, interest rates were very high, and it was not uncommon to see interest rates on loans in the teens. You'd have 15, 16% interest on some loans. That's not something that we've experienced in the last decade or two in the United States, but it is something that could happen. And so we'll see where interest rates go in the future. So the credit industry consists of a number of companies. FICO, you might have heard of a FICO Score. FICO stands for Fair Isaacs Corporation, and they're the company that kind of invented credit scores. Fair Isaacs, back in I want to say the 80s, but I'm not 100% sure what year they started. But they back in somewhere around maybe the 70s or 80s, they started a company to keep track of people's borrowing, and it's really like a data management company, but they use the data that they have to put together a statistical analysis, a probability of will somebody pay their debts. And so they look at debts that you paid before and how much you borrow compared to how much you earn, and a few other topics, criteria that we'll look at, and they come up with a score. And so your FICO score is from Fair Isaacs Corporation, and it's just an analysis of previous debt loads that you've had and how you've paid them back. And so they keep track of data, but they also work with 3 credit bureaus. And these are the major 3 credit bureaus in the United States: Equifax, Experian, and TransUnion. And each of those 3 is really like a personal information data warehouse. It's kind of they just keep a lot of information on everybody, pretty much everyone in the United States. If you've had any experience with borrowing money or owing for any reason, you have a credit card, you have bank accounts, you have a loan of any kind. There's a lot of different ways where your information would show up on any of these credit bureaus reports. What they do is they keep a database of information about you, and then they use that information to compile a credit report. And a credit report will have a list of previous debts that you've had, whether you paid them on time or not, and some other information about companies who have maybe pulled your credit report and why they pulled it. Meaning that they have looked at your credit report in order to maybe issue you a line of credit or offer some credit to you. So you may have experienced getting in the mail credit card offers. Those are pretty common, especially if you have a decent credit score. You may get unsolicited credit card offers in the mail. You just, we a lot of time think of it as junk mail. And maybe a credit card company says, hey, open an account with us and you're pre-qualified and those kinds of things. That's because they called one of these 3 credit bureaus and said, hey, can you give us a list of everybody who lives in this area and has a credit score above this rank? And they say, give us a list of people who meet these criteria. And we know that statistically, people who meet all those criteria are very unlikely to default on a debt. So we'll send out pre-qualification letters to all those people. And that's one of the services that these 3 credit bureaus provide. So there are now alternative credit bureaus as well. Vantage is a pretty well-known one. They offer kind of an alternative version of credit reporting, and they bill themselves as being more accurate, more reliable for lenders. I don't really know what, from a lender, I don't lend money to people, so I don't know from the lender's perspective which of these is better or more accurate or is more reliable or anything like that. But Vantage Score kind of bills themselves as the alternative option for the FICO score. But there are other kind of new to the game, new to the industry credit reporting agencies and consumer reporting agencies, not just credit, who will include things like real rental history and utility payments and things. These things aren't necessarily debts, they're just regular monthly bills that come in. You think of a utility payment, you know, when you use your power, you get a bill from, maybe it's PG&E or somebody like that. And you get a bill, and I mean, yeah, technically you owe it, but it's not a debt like a loan. Like, it's not a big loan that you're paying monthly on to try to pay it off. So those things typically don't show up on in credit reports, although with the newest versions of credit reports, they have been becoming more common. And so some of the things that historically were not included in credit reports now have become more likely to be included. And so we'll talk about all the different things and how much each of these things have a factor on your score, and which ones you can, you know, safely ignore and which ones you really need to pay attention to. We'll get to that in just a minute. So how the credit reporting process works, how do they get any of your information in the first place? Well, lenders can become members of the credit bureaus, and they can be a data furnisher is the word that they use. And if a lender wants to furnish data to a credit bureau like Equifax or Experian or TransUnion, they can do that, and they sign up to send data to those. And in exchange for sending data to those credit bureaus, the credit bureaus also allow those data furnishers to pull information to see, maybe check someone's credit score. And so you can think of a bank as a very common need, a commonly recurring need to check people's credit scores, because banks lend money all the time for mortgages, for businesses, for cars, credit cards, all kinds of things. And so banks frequently need to pull someone's credit report to see if they qualify for a loan. But they also, in order to pull that credit report, the credit bureaus want to make sure that they have the most accurate information available. They don't want to have outdated information, because if they did, no one would use their data. And so they have an agreement in place with banks and credit card companies, sometimes with property management firms, sometimes with, you know, anybody who has a reason to lend, mortgage companies, those kinds of things. And so they have an agreement where we will let you utilize our data, but you have to make sure that it's updated on your end. And so you send us data telling us that this person has made their payment on time, or maybe they missed a payment, or how much they owe in total. And all that kind of data comes into the credit bureau in exchange for the lender being allowed to utilize that information. Some lenders are only members of one of the credit bureaus. If you're a small lender and you don't want the expense and the logistical work of having to manage data with all three of the major credit bureaus, you may only be a member of TransUnion or only a member to Equifax, you know, those kinds of things. But some major corporations, especially, you know, some of the big banks that we know of, like a Wells Fargo, a Chase, a Bank of America, those kinds of things, they probably would be members and report to all three of them, because they do so many loans. Financially, it just makes sense for them to try to get as much of the information as possible. You wouldn't want, you know, one credit report to have some information and another credit report to have different information, and you didn't get the correct information because you were only a member of one of them. And so a lot of banks may pull from just one of the three, or from all three, depending on their needs. The lender agrees to report to the bureau in exchange for being able to pull data. That's kind of the main thing here. If you enter into a loan, then let's say it's with a bank, the bank will first do a credit check. They're a member of a credit bureau, so they'll check your credit, say yes, you're qualified. They'll lend to you, then they'll report to the credit bureau that you paid on time, or here's how much that you owe, and they keep track of the balance monthly. And so if you ever look at your credit report, and I'll show you how to do that in a minute, but when you look at your credit report, it'll say each month whether you paid on time, what was the high balance, what was the low balance, meaning how much did you owe, but did you pay it down? And then did you pay on time? They also keep track of how late were you. So if it's either on time, then it's just good. But if you were late, was it 30 days, 60 days, 90 days late? Is it in collections, or was it repossessed? Sometimes, you know, with cars, for example, if you don't make payments on your cars and it goes way past you're 90 days late on the car payment, it may be repossessed. And that's a pretty major red flag on your credit report, having a repossession on there, because that's a pretty bad sign in terms of making payments. There are other consumer reporting agencies as well, and I referenced some, you know, other options. But in addition to consumer report or credit reporting agencies, oops, you can go to consumerfinance.gov. So there's the Consumer Financial Protection Bureau and the Federal Trade Commission keep track of consumer reporting agencies, and there are all different kinds of consumer reporting agencies, and they're not all just credit score related. So there's banking information, there's insurance databases, there's medical data, driving records, all kinds of different things that are kept track of by many different reporting agencies. And what they do is they keep track of, say, for example, banking information. There's a pretty big banking information consumer reporting company called Chex Systems. When banks go to open credit checking accounts, if you want to open a checking account, have a debit card, have a checkbook, many banks will check with Chex Systems, and Chex Systems keeps data on people who bounce checks or overdraft their account frequently. And a bank could deny you a checking account because they see that maybe you've bounced a lot of checks in the past, or that you frequently overdraw your checking account and then close the account in an overdrawn position and then leave. A bank might not want to open a checking account with you if that has a if that's a common occurrence in your past. It does make for some problems with people who have their identities stolen, and I'll get to some examples. I have a couple examples of that later on. But if your identity is stolen and somebody drains a bank account and overdrafts it, that could cause a problem for you trying to open a bank account in the future, because your bank account was overdrawn and it wasn't your doing, somebody stole from you. But that's a common issue that some people have to deal with. So FICO Score is the score for that keeps track of your credit score, and they create updates to the FICO Score system pretty regularly. And so similar to like an iPhone, every so often a new iPhone comes out and they give it a number. They're currently on FICO 10 as of this recording, and they actually created a secondary kind of alternative to that called FICO 10T. And so there previously was a FICO 8 and I think FICO 3. I forget every single version that there's been, but they come out with new versions pretty regularly. A lot of lenders are still using FICO 8, and I believe there's a FICO 9, but now they are on 10, and so a lender can choose to use maybe 10 or 8, depending on their needs. But the newest updates change a little bit about the way that they do the statistics and the way that they measure debts and repayments and those kinds of things. And 10T, the T actually stands for trend level data. And so what they do is they actually are looking at if you're making your payments on time is the normal thing that they look for in FICO, but are those payments increasing or decreasing over the last 2 years? Are your balances increasing or decreasing across all of your accounts? So let's say you have maybe 2 or 3 credit cards and the balances on all of them are going up steadily over the past 2 years. That may have a major factor on your FICO 10T score. Whereas previously in FICO 8, they just looked at what's the balance on each of the accounts. Is that a high balance or a low balance? But if it's trending up but still low, that could signal that maybe you're getting to be in a little bit of trouble with credit. Maybe maybe you lost your job or something like that, and you had to kind of supplement your lifestyle with credit cards, and you're going to get another job soon, and you'll be able to pay that down, but you're not in that place yet, right? There's a lot of factors that go into credit scores. So FICO 10T looks at, okay, this is trending up or this is trending down, and will make adjustments to your FICO score based on the trends that are happening. So another thing to know about FICO scores, this is a little bit of a misconception here. Medical debts end up being reported differently than other debts. And so what happens in the United States with medical debts is that a lot of times you have maybe your insurance company will reimburse costs, but insurance companies aren't known for being really speedy or really easy to deal with. And so sometimes you end up with a medical debt that's really not a good reflection of your use of debt, right? People who have really large medical debts that are unpaid aren't necessarily people who are bad at managing their finances. Medical issues happen to people completely unexpected. Emergency situations happen. And so FICO, when they're measuring the statistics about people's ability to repay loans, they realize that a lot of people who have medical debts that are causing their credit score to be really low aren't actually unreasonable people to lend to from a banking perspective. Someone with a large medical debt might not necessarily be somebody who's not going to pay their mortgage or not going to pay their car or something like that. And so a medical issue isn't really a good reflection on whether somebody will pay. And so they have changed the way that they report medical debts and how they affect your credit scores. And so Right now, if you are up to 180 days late on a medical debt after it gets reported to maybe a collections agency, it won't affect your credit score at all, because they assume, something's going to happen here probably, and it could be that you're simply just waiting for the insurance to reimburse, and so that could take quite a while, and maybe you have a medical debt in collections, but then the insurance company sends you a reimbursement and you pay it off and it's gone. And if all of that happens in less than 180 days, then it won't ever even show up on your credit report. It's not going to make a difference at all. And so that's the system that they're using now for medical debts. Lenders can choose, when they are members of one of those credit bureaus, they can pay to use the FICO 8 score, which is probably less expensive than the new FICO 10 or 10T. And so they may choose that they aren't the new innovations in credit scoring aren't worth the cost for some lenders. Some lenders want the most updated information, and so they'll pay for 10T. But it depends on each lender which one they pull. We do in the United States have the Fair Credit Reporting Act, and the FCRA requires that anyone who pulls your credit report in order to make a lending decision has to tell you how they made the decision and where they got their information, and they'll tell you the FICO 8 or FICO 10, what score they pulled and what the score was. And so you'll get a report. You may have experienced this if you've ever gotten a credit card or a loan of any kind. They have to mail it to you. You will get it in the mail. And it will say, we pulled your credit and we offered you, we either did or did not offer you a loan based on this information. And you have the right to contest this information if you think that it's false. And so everyone in the United States, because of the Fair Credit Reporting Act, has the right to contest incorrect information on their FICO score. So if they say, hey, listen, you applied for a mortgage and we pulled your credit report and found that you have 10 mortgages already. And you say, there's no way I have 10 mortgages already, that's wrong. That's probably pretty obviously wrong. And so that might not be so hard to fix, because any human looking at that would say, yeah, that's probably not true. But sometimes there's less obvious information, like, oh, hey, we have a really high balance on this credit card that's showing on your report. You say, no, that's not my credit card balance. And then you can contest that and maybe just show them a statement proving that your balance is not that high, and then it gets fixed. But sometimes it's a little hard to contest if it's not so obvious. Sometimes it's easy to contest if it's very obvious, if it's fraud or something like that. And so you'll get a report from any lender that says, we approved you or we did not approve you, and here's why. And then you have the chance to respond to that. So when you get a credit report, so I want to differentiate this two different terms here. There's a credit report and there is a credit score, and those are not the same thing. They are used similarly, but they're different items. And so a credit report is a list of things that you've done relating to credit. And so it could be that you've borrowed money for a mortgage. It could be that you have student loans from college. It could be that you have credit cards, a car loan, a line of credit on your house. There's so many things that could be on a credit report. And that's simply a list. And the benefit to looking at a credit report is so that you can go and see if there's any false information. If somebody has stolen your identity, many times, not always, but many times it will show up on your credit report that somebody maybe took out a loan in your name. And the way that identity thieves work is that they have stolen your information somewhere, somehow, maybe through like a data breach or some hacking event of some kind. I don't really know, but they've stolen your data in some way, and then used your information, your social security number, your name and birthday, maybe your address, a bunch of information about you, and used that to apply for a loan, received funds, and then because they used your information and not their own, they're going to keep that money, never make a payment, and they don't care about you, and so they're not going to make a payment back, and they're just going to keep that money and go, be criminal somewhere else. But now you're stuck on the hook, saying, with your credit report showing that you owe a bunch of money that you did not actually borrow. And so then at that point, you have to work to fix your credit report. I'll show you how to do that. You can contest false information in just a minute. We'll talk about that. But that's a credit report. A credit score is a number, and that number is supposed to represent your ability to pay debts. And so if you have a credit score of, let's say, 800, that's pretty good. That's really good, actually. If you have a credit score of 800, you're doing just fine on the credit score. And then generally your credit report probably shows a lot of good things. You've paid off debts, you make all of your payments on time, You probably don't have so much debt that it's a huge burden on your life, right? Then all of those things kind of fit together. But a credit report and a credit score are not the same thing. Those are not exactly the same thing. There are services, and you've probably seen them, and I won't name anything in particular. I don't have any affiliation with any of these services, but there are many online services that you can pay, or some of them are free, to give you a credit score. They'll tell you what they think your credit score is. But unless you're paying FICO directly, then most credit score reports are just estimates based on your credit report. So some of the ones you've probably seen TV commercials and heard radio commercials about some of them, where you can go create an account and they'll pull your credit report for you, and then they'll scan it for you and then say, based on all the things on your credit report, we think your credit score is 725 or whatever number it happens to be. And generally, they're fairly accurate. They might not be exact, right? If a credit reporting, one of those free credit score companies says that your credit score is 725, you have a reasonable assumption of thinking, well, it's probably between 700 and 750, right? That's it might even be, they might even be a little better than that. If they say 725, it might be between, you might know that your actual FICO score is between 715 and 730. It's pretty decent range there. So that they're not going to be way off. But FICO does have like a copyright or a patent, or I'm not sure what the title of their licensing here, but they have intellectual property rights surrounding the formation of the FICO score. So it's called a FICO score. And if you're not FICO, you don't have the formula. They're really secretive about the formula, but you can make a good estimate. And so that's what those other free credit reporting agencies are. They are great tools. I'm not saying that they're wrong. I'm just saying that they're not exactly perfect. But they are great tools to use if you want to figure out what your credit score might be, so that you can make a decision on to whether or not to take out a loan, or how you might be able to fix your credit score. There is an official source, that there is federal law that dictates the official source for credit reports. And you can go to annualcreditreport.com. That is the official website to pull a free credit report for yourself. You can use that. And historically, it's been that you could get a free credit report every year from each of the 3 credit bureaus. But actually now, during the time of COVID, they have allowed everyone to get a free weekly credit report. So every week you can go and get a credit report for yourself and check it for each of the 3 credit bureaus. And that's more often than most people need. If you've had your identity stolen, then you actually can get more free credit reports if you needed to. But if you've not been the victim of identity theft, getting a free weekly credit report is just a little excessive. You can get by with getting one every few months and it'd be just fine. But that tool is available for you if you want to. You go to that website, you can choose which of the 3 credit bureaus you'd like to get a credit report for. And each of the 3 credit bureaus, remember that lenders can be members of 1 or 2 or 3 of the credit bureaus, and they'll report data to those credit bureaus. So it's possible that some lenders that you've worked with in the past were only members of, for example, let's say Experian. So maybe some lender that you've worked with in the past was only a member of Experian and not a member of TransUnion and Equifax. And so your Experian report may show different information than your TransUnion and your Equifax report. And so you may want to consistently cycle through all 3 of the credit bureaus and pull credit reports for all 3 of them to see what information is different, and if there's false information on one of them but not the others, or something like that. That's a pretty useful tool to combat identity theft. So normally you'd be able to get a free report every year, but as of right now, as of the recording of this video and this webinar, you can do it weekly. So when you choose, how do you decide when to pull a credit report from any of the bureaus? If you're in that time period outside of the weekly allowance, and let's say you're able to pull a credit report once a year from each of the 3, historically, a lot of people have done every 4 months, because there's 3 credit bureaus. So every 4 months, you pull a credit report from one of them, and you just alternate which one you're pulling from, so that you get one a year, but you get one every 4 months, because you'll pull Equifax, 4 months later you'll pull TransUnion, 4 months later you'll pull Experian, and then 4 months later will be a year mark, because you'll have crossed over that year, because it's 3 periods of 4 months. That's a whole 12 months. And then you just roll back over to the first one, and you just do that cycle again. And by doing that every 4 months, you consistently get to pull your credit reports, and you get to see that there's nothing false on there, and you have a regular reassurance that things are going right and your identity hasn't been stolen. And that's fine to do. That's what a lot of people do. And I think that's a pretty good method to approach it at. But there's another option too. You can pull all three at the same time and just say, on January 1st every year, I'm going to pull all three credit reports. And then every year on January 1st, I'll pull all three credit reports. And that's fine too. You can do all three at once. Then there's pros and cons to each method. If you do the all three at once method, that tells you, remember I said that some of the credit reports might be different than others. That gives you the whole scope, everything all at one time. You know for sure you have all the information there is possible to have. And then you can check all three at once and know as of that date, you're good to go. But then you have to wait one whole year before you can do that again. And so depending on your plans, that may be a good idea or maybe a bad idea. If you plan to apply for a loan in the near future, let's say in the next month or two, then getting all three at once probably would be a good idea, because you don't want to go apply for a loan and then get denied because of some incorrect, fraudulent information on one of your reports that you happen to not pull because maybe you were on that every 4-month cycle instead. And so you just, if you're planning to borrow money, pull all three, check all three, make sure everything's good, then you can apply for a loan. If you're not planning on pulling or on borrowing money in the near future, and you just want to make sure nobody's stolen your identity, then a 4-month cycle and alternating between the three makes sense, because you don't have that impetus of something that's about to happen that you need to get all of the information right there. So I wanted to give an example too. So previous to me to working at the Financial Wellness Clinic and running that at FICO State, I was a financial planner, and I had a client one time who came to me, and I won't name the name of the company, but he had an account in collections with an internet provider, and the internet and as you can imagine, a lot of internet provider companies aren't known for being easy to work with and fun to deal with. And so he had at the time he had moved and had returned the internet box for that provider and had sent and taken it back to the store place, the storefront. And they did not record that he had returned it. And so they were billing him for that box, even though he had turned it in. And so he said, listen, I have proof that I turned it in. Here's, I think it was a receipt and maybe some kind of statement that showed that he turned it in. But they said, no, we don't have any record of that. We're going to keep billing you. You need to turn it in, or you need to pay some number of hundreds of dollars to cancel the account, and we'll report it as lost. And he said, no, I'm not doing that. I definitely returned it. And then so what happened is the internet provider sent the account to collections, and so that it was reported on his credit report that he had an account in collections, and it really hurt his credit score because it shows as him having not paid it. But he had the evidence to show that this was not true, and so he ended up having to report that. So after we tried very hard to go through, he and I worked together on this to go through the internet company before saying to the credit bureaus that this is a fraudulent account. We sent in evidence and we tried to prove it, and the internet company declined to remove that from the credit report. So we went to the 3 credit bureaus and we said, listen, we would like to dispute this account. It's incorrect. This debt is not owed, and it was reported fraudulently. Maybe not fraudulently is too strong a word, but it was reported improperly. And so we sent in evidence to the credit bureaus. We showed them the receipt. We showed them the payment. We actually also printed and sent in an email chain back and forth with the internet provider to show here's the discussion that happened and when we tried to let them know. And what happens is once you dispute a report on your credit report, or a negative mark on your credit report, the credit bureau then goes to the lender. In this case, it was a collections agency, to get their side, and they have about 30 days to respond. If they don't respond or they can't prove the debt, they have to come up with the paperwork and the documentation to prove that debt is valid. Then that item will be removed from your credit report. And so that's what we did with this client. So the credit bureau was able to remove the account, and then the credit score was restored, and it was just fine. And so because that internet provider was not able to prove a counter to the receipt of us turning, or him, the client, turning in the box, everything was good to go. It is a little bit of work, it's kind of a pain, and they do make form letters that you can Google, boilerplate form letters for disputing a credit report, negative mark, and you can use that and fill in the blanks, and you have to send in a written letter. I think at the time, now you might be able to do everything entirely online, but at the time that this happened, they probably wanted us to fax them some information and that kind of thing. which is a little more of a hassle to deal with. But now that so many companies have gone online and digital for so many things, it might be a little bit easier to do it today. So now let's talk about the 5 factors of a credit score. So when your credit score is determined by FICO, they are really strict about not telling anyone exactly how they do the formula, but we have some basic guidelines based on a lot of things that we know about credit scores and how those things are determined. And so there are, in general, 5 factors to a credit score, and they each make up a certain percentage of your credit score. And so we'll go through each of these individually, but I just want to kind of outline the most important ones on here would be payment history and the balances owed. And so you can see over here, your payment history is 35% of your score, your balances owed is 30% of your score. And so whether or not you're making your payments on time and how much you owe on your debt, those are going to make up the largest piece. That's 65 combined, that is 65% of your score is just those. And so if you could focus on nothing else, making your payments on time and lowering any debts that outstanding that you have is going to increase your score the most dramatically. But if you're trying to have the best credit score, then you can start focusing on some of these less heavy options that maybe have less of an effect on your score, but still are important, right? And we'll go through each one of these individually. I do wanted to also outline the credit score ranges from 300 on the worst side to 850 on the upper end. And so a perfect credit score would be 850, but very few people have all the way up to 850. It's not as common to have that high. And in fact, if you're going to borrow money, you can see that there's a whole range right here of from 720 to 850 is the excellent section of credit scores. If you're above 740, I've talked to a lot of different banks and lenders. If you're above a 740, you're going to be qualified for the best rates no matter where you're going to borrow. So if it's for a mortgage, if it's for a car loan, anything like that, if you have a credit score more than 740, it's not actually going to affect your rates any better. So somebody with a 740 credit score and somebody with an 800 credit score will get the same interest rate on a loan. Those are both excellent, right? And so I've asked a lot of banks and a lot of lenders. I have a lot of friends who work in the finance and lending industry, and I've checked to make sure that that is true. And it is in fact true that if you're anywhere in that excellent range, you're going to have the same interest rate on your loan, no matter how deep into that range you are. Once you start getting out of the top end range, or in this good range, or even that fair range, you're going to start seeing higher interest rates on your debts, which is kind of the pay to play kind of way that our system works right now. And so you're just going to have to, you can either improve your credit score or pay higher interest rates on your debt. So first factor here is payment history makes up 35% of your score. And this is completely about don't miss payments, make your payments on time. There is a little bit of some leeway, is that or lenders reporting to credit bureaus don't report immediately. And so sometimes you can get away with making a payment a little bit late, and then as long as you make the payment before they report to the credit bureau, it may get reported as that it was paid on time or it's paid in full. But I would never rely on that. I would always, if you have a set due date for your payment, try to pay it, a day or two early if you can, so that you don't mess up. But as long as you're making your payments on time, the way that they show on a credit report, I didn't have a good example because I didn't want to pull some person's credit report and show that here on a recording. But the way they do it is they go by month, and so it ends up looking kind of like this, and it'll say, January, February, March, and so on. And then for a lot of them, it'll just say check, or it may say like 30, or it may say 60 or something like that. And so the check mark says good, on time, and generally it's like a green check. And so if all of your, let's say you have a bunch of boxes like this, and all of them have check, 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 check as they go down, then what that signals is that every single payment was made on time, and that you're paid as agreed upon. It doesn't actually say the amount that you paid in that box, although separately there's a line that shows the amount of the monthly payment. And so maybe if it's a credit card, your monthly payment is $50, or it'll say some amount, as a monthly payment, and then it'll say the high amount, which means how much have you had during this period, what was the highest amount that you owed. And if it's a credit card, you may have racked up $5,000 in debt or something like that, depending on the size of your credit limit. And so it'll say maybe at one point you had a $5,000 balance, your monthly minimum payment is 50, but every single month you paid on time as agreed upon. Sometimes that payment was really high, especially during the time where you had that $5,000 balance. And sometimes it was really low because maybe you paid off your credit card at some point. And so they don't say the number there, but they do say what the minimum was and that you paid it on time. If it says something like 30, or there's some symbols that indicate, repossessions or collections or something like that, it may say, depending on the credit bureau, it may say REP for repossession. So you could have been, this would be a pretty extreme example if you saw 30 and then REP, that would be pretty tough. But what it means is you were 30 days late in January and you didn't make the payment, and then in February they came and repossessed it. That's possible, especially with a car and very strict lenders. That would look pretty bad. This would be a pretty negative report, and it would be part of that 35% payment history on your credit report. This would be pretty negative. But something that might be more likely to happen is you might see a 30, a 60, a 90, and then a repossession, because what that says is you were 30 days late, it didn't get paid. Then then the next month you're 60 days late because another month had passed and it still wasn't paid. And then the next month, 90 days late, still not paid, and then it gets repossessed. That would be a pretty normal, or maybe not normal, but that would be, if I saw this, I wouldn't think that that seemed outlandish. You're 90 days late on your payment on a car, they're going to come take it back, right? And then they're going to charge you. They're going to try to auction it off, and you have to pay the difference. And insurance gets involved too, and it's just a mess. You don't want, I mean, if you can help it, you don't want to deal with any of that. And so you don't want to have, the more late you are, the worst case scenario. But if you can help it, you don't want to have any late payments. You want to make, even if it's your minimum, make at least the minimum payment. But if you can pay more on your debt, what they'll tell you on credit cards, they'll send you a statement and they'll say, if you were to pay just the minimum, this is how much you would end up paying in total over the next 3 years or so, and this much in extra and interest. But if you pay more than the minimum, you can reduce the amount that you pay. Credit card statements always say things like that. They're required to as part of the Fair Credit Reporting Act. But they'll say kind of a minimum payment notice, and you can say, well, maybe I'll pay a little more than the minimum so that I'm not paying so much extra in interest. And that won't paying more than the minimum won't change the fact that you paid on time, right? Remember, the only indicator is check mark. And so the lender or the credit bureau will say, yes, they paid on time. Did they pay more than the minimum or not? It doesn't say, but that's kind of what you can think of. It's really for your benefit to pay less in interest over the life of the loan. The next section or category that makes up a lot of credit score is the balances owed. So if you owe a lot of money, and it's not actually so much of how much do you owe. You could have a credit card balance of $50,000 that you owe on your credit card, and that may or may not be a big deal depending on your lifestyle, right? If you're Elon Musk or Jeff Bezos, owing $50,000 is probably not a big deal. You have the money to pay for it, right? But if you're like most people, owing $50,000 on a credit card is pretty extreme. That's not the normal case for most Americans to have $50,000 in credit card debt. And so the question on balances owed is, how much do you have owed on your credit card compared to how much you could owe on your credit card, right? And so if you, for example, if you have $1,000 total credit limit, which may be normal for an introductory card, or some student credit cards have a $1,000 total limit. Generally, once you get into your 30s and 40s and you have a full-time career type job, I work with a lot of college students, and so I'm generally approaching this from the mindset of somebody who graduates college and then moves on. But if you're maybe in your 30s and 40s and have a decent career, you may have a credit card with a higher than $1,000 credit limit. But let's say you're early on in your life and you have your first credit card. It has a total of $1,000 credit limit, and you rack up $900 in debt. That means you are using 90% of your available credit, and balances owed looks at your available credit, right? And so using 90% of that is a pretty bad scenario in terms of your balances owed. So that'll look bad. It's utilization, as they call it. Credit utilization is really high in that case, and that's a negative sign. That means you're kind of stretched thin, and you may run into some trouble in the near future. They kind of assume that whatever your credit limit is a factor of your income and a factor of your lifestyle, which may or may not be true for a lot of people. And so that may not be a good assumption to make, but that's what they do. And so they say, well, if you had $1,000 in credit limit and you use 900, that probably means you're struggling to make ends meet. They don't think, oh, well, you make $250,000 a year in a salary, and so owing $900 doesn't really, it's not a huge factor. That's not the way they think about it. But if you had a $100,000 credit limit, and then you owe $9,000 on it, we can kind of look at this right here. 100,000 total limit with a $9,000 balance is really only 9% interest, or 9% utilization, which is very low actually. Most people are hovering maybe around 30% in utilization, and so 9%, that's looked upon favorably, even though the difference here is the first person who's in a bad case owes $900, and the second person who's in a good case owes $9,000, right? The second person owes 10 times as much as the first, but they're in a better scenario because it's about how much total available credit, what's the credit limit on that card. And so that's a major factor of your credit score as well. So if you can pay down some of your balances, that will impact your score as well. So if you have a really high credit limit, or sorry, if you have a really high credit utilization, meaning you have a high balance on your card, start paying it down regardless of what your total limit is. Next factor here is the length of credit history. Now this is a much smaller factor. But it's kind of right in the middle of the list. And so 15% of your score is attributed to how long your accounts have been around. And so if you opened a bank, or maybe not a bank account, a credit card account or a debt account of some kind when you were very young, and it's been 15 or 20 years, your length of credit history would probably be okay. But it's actually an average age for your accounts. And so let's say when you were 18, right out of high school, you got your first credit card, and that's just kind of what people did back in the day. And so maybe you've had that account open for a long time, and so your length of credit history might look pretty good. But then you go open a bunch of new accounts later in life. So you've had this one card that's existed for a long time, and then after 20 years you open 3 new cards, right? And they're all short because they were just opened. Well, the average length here is going to be, all these short ones are just going to mean your average length is much shorter, something like this or something. And so your length of credit history is going to take a dip because you opened a bunch of new credit cards back to back. Now, it's okay to open a new credit card. It will hurt your credit length a little bit, if you had just one new credit card, and that's going to, attribute. Let's say this is like 10 years, and this is you open one and it's been open for 1 year. So the average here, 10 plus 1 is 11, divided by 2 would be 5.5, right? And so your average length here is 5.5. Whereas if you open like 3 new credit cards, let's say each of these is 1, then you have a 10 and 3 3s. That's a total of 13, but divided by 4, 13 divided by 4 is about 3 and a little bit more than 3. Let's just say 3.5. I'll round it a little. But now your average score or your average length has dipped quite a bit. You went from 10 to 3.5. And so that's going to hurt your score a lot to open a lot of new accounts back to back to back. And so what you can do is wait a little while before opening new accounts. Maybe if you're going to open a new one because maybe you need to open a new account for some reason, that's fine. Let it get a little older before you then open a second, a third, a fourth, right? And what you want to do is once you get to about 7 years, that's long enough to be a mature account, and then you don't want to you can open another account after that and you'll be okay. You just want to keep your average, if you can keep your average length of credit history to 7 years, you'll be just fine. So let one get even older than that before you open a new one. That'll be okay too. So one thing you can do is don't close an old account. If you have an old credit card that's been paid off and hasn't been used in a while, it might be of interest to you to say, well, maybe I'll close it so it doesn't sit there doing nothing. But if it has no balance, it's not accruing interest. You're not making, maybe it doesn't have an annual fee, or maybe it does, but you can leave it open and let that help your length of credit history. That's one option there, is just leave old accounts open. The next piece is credit mix. That makes up 10%. Now we're getting into the 2 bottom in terms of the effect on your score. Credit mix still is important, but it's about 10% of your score. And so I would not prioritize this one over the others. But if you are trying to get a perfect score, an 850 credit score, then you might want to focus on this. Credit mix just means you have a lot of different kinds of credit. And so if you take the pie chart of life, and you say maybe you have a mortgage, I'll put MOR for mortgage. You maybe have a credit card, maybe have a student loan, And then maybe you have, what's another one, a car loan, an auto loan, right? So you have 4 different kinds of credit. That's going to be seen as a good thing. So lenders want to know that you have some experience dealing with debt so that they can say, listen, this person isn't so much of a risk to us as a lender because we know that they've done a good job with a credit card, they've done a good job paying their student loans, they've done a good job paying on their car, there's maybe still have a mortgage with a high balance because mortgages in California are very expensive, but maybe you've done a good job making those payments. As a lender, I'm going to say, listen, you're doing great. Obviously, you know what you're doing. And if I were to lend to you for a new car loan, I don't have any expectation that you don't know what you're doing, right? That you're unsure of how to make payments, or that you're unsure of your personal finances or anything like that. I'm pretty confident you're going to be okay. And so credit mix is one of those things where the more different kinds of debt you have experience with, the less risky you seem to be. Now, it is a smaller piece of the total credit score, and so I wouldn't go about. Remember the last slide, I'll go up one slide real quick just to show length of credit history is one of those factors here. I would not go and say, well, if I only have, let's say I'm right out of college, I only have student loans, I don't have a credit card, I don't have a car loan, right? These are all gone. I don't have a mortgage yet, I'm still renting, I'm a young person, right? I wouldn't want to then go open a car loan and go open a credit card in order, if my thought process was, oh, I'll increase my credit mix, that will help my credit score, because what's going to happen is that's a bunch of new accounts. And so maybe your student loan's been around for a few years, right? Maybe you got a student loan your freshman year in college, and so that's existed for 4 or 5, maybe 6 years. And then you go open a new credit card because you're trying to increase your credit mix. Sure, that will help 10% of your score, but if I go up one slide, it will hurt 15% of your score, right? And so overall, your score would actually end up going down in that case. So you don't want that. But if you have every other section of your credit score totally under control, totally in good shape, and you're just trying to get the perfect credit score because that's important to you personally, then maybe you want to focus on credit mix. Just know that going to open a bunch of different accounts in order to increase your credit mix will hurt your score in the short run, but over time your score will build back up, and it would build back up to a higher credit score, because then you have a better mix, right? You just have to think long term and say, over the next 3 years, my target is to get my credit score up to 820, maybe. I'm just going to throw a number out as an example. Get it up to 820, but I know right now my credit score is at 750, and if I open a bunch of new accounts, it'll increase my mix, but it'll also lower my average age. It'll drop down to 700, but over the next 3-4 years, it'll go back up to 820. It'll be good to go, right? You just have to have that long-term mindset. The last factor on here is new credit. And so this and credit length are combined here they're actually 2 different areas, but they overlap quite a bit. And so this is where a lot of your score can be affected, because you open a new account. If you open a lot of new accounts back to back to back, not only is your average account going to go down, but the risk factor here from a lender's perspective is somebody who's shopping around a lot and trying to open as many new cards as possible is seen as somebody who probably has some kind of financial problem going on. And unfortunately, the way our system works is that the people who need to borrow money because they're struggling are the least likely to be approved to borrow money, because no bank wants to lend to somebody who's struggling. They want to lend to wealthy people who are going to pay them back and not even think about it. And unfortunately, that's the way our system works. And so the people who need the money the most are going to have the hardest time getting it. If you go around and say, hey, I need to get a loan, it's really important, I need like 6 or 7 loans, any bank that hears that is going to say, well, good luck with that. We don't want to lend to you, because what they're seeing is that something happened in your life. It could be an emergency, it could be a medical situation, it could be some unforeseen circumstance, but whatever it is clearly having a problem on your finances, and that means you might not be able to repay us. And the bank cares about themselves, and they care about their money, right? The bank cares about, are you going to repay them? They don't really care about you as a person. No offense, I'm sure there's a lot of people who may watch this video and think, hey, I work at a bank, I care about my clients, and I get that, but in general, banks are going to make financial decisions based on the payoff, right? And so once an account has been around for 7 years, it's mature, it's good to go. It's not going to be considered new credit, so you can open new accounts after that point just fine. If you open a new account, it will drop your credit score because of new credit, because of length of credit history, but over time it'll build back up. So I want to give you another example of identity theft, and this is, we're going to take a little bit of a separation here from credit scores and talk about just identity theft in general. A lot of times the way that identity theft happens is somebody gets your information and they use it to take out a loan. We talked about that a minute ago. But one thing that happened to me in my life a few years ago was I had my identity stolen. My information got out, I'm going to guess, through one of those data breaches. There's one very famous one that happened with Equifax. There's another pretty well-known one. Target had a data breach. Home Depot had a data breach. I have shopped at Target and Home Depot. So, I'm sure Equifax has, I know that Equifax has a lot of information about me. So my information at some point has gotten out there into the world, and some identity thief was able to get a hold of it. That doesn't surprise me. I know that is a thing, but what did surprise me was that when my identity was actually stolen and I found out about it. And so what happened was, the way that I was signaled to it is I got a bunch of letters in the mail. Just for a period of like 2 or 3 weeks, I got tons of letters from banks, all kinds of different banks, some that I had never heard of before, saying, thank you for opening a new account, but unfortunately your account balance is now overdrawn. And it was always about $200 or so. So all these accounts were being opened in my name at various banks that I knew I did not have accounts with, right? I got, from banks I'd never heard of, and they said that they were overdrawn. So what happened is somebody got my information, opened a bunch of bank accounts, immediately withdrew $200 or so from each of those bank accounts, because that's about the maximum that you can take out of an account, like at an ATM or something like that, and overdrafted those accounts, and then took that money and left, right? And now I'm on the hook because all these banks are sending me, notices saying you need to, bring your balance back up to at least zero, to bring it back to positive, because they're all overdrawn. And now I knew those were not true. And so the first thing I had to do is I started calling the banks that were sending me letters saying this is fraudulent. One thing I did do is I called the bank. I looked up the phone number for the bank. I did not call the number that was on the letter that I received, because there are scams where people may call or may send you a letter saying call this number, and it's a fake number to their office somewhere else in the world, where they will then try to trick you to sending money or something. So I looked up independently. I looked up the bank and its contact information, and I reached out to their fraud department. I let them know, hey, this is a fraudulent account. I did not open it. And a bank in general knows, okay, that happens. And so they most of the time won't challenge you on it. They'll say, that's fine. If it's a fraudulent account, we need you to file a police report and send that to us so that we can have a record of it. They'll generally tell you how to report fraudulent activity to the credit bureaus, which you can do. Actually, if it's fraud, you can report to just one of the credit bureaus. And when it's fraud, each of the credit bureaus has an arrangement that they will then announce to they'll show to the other credit bureaus that there was fraud happened, and they'll make a note of it as well. So you only have to report fraud to one of them, and the other ones will then get the report. And so what I did is I filed the police report. I put in a fraud account to the credit bureaus, and then I contacted each of those banks individually to let them know, directly, hey, this is a fraudulent account. Here's the police report. And then because these are bank accounts, I then also reported to a system called checks systems. And so checks systems is what banks use to check if somebody overdrafts their account very frequently, or if they bounce checks. And so I reported fraud to check systems as well, which is a different consumer reporting agency, to let them know that there's a fraudulent account. And that way, if someone ever tries to open a new checking account at a bank using my information, they'll see a fraud alert at check systems, and hopefully they will say, hey, we can't open a new account under this name unless we see this person actually physically at the branch, or we have some sort of proof of identity. And so that'll hopefully cut down. And since then, I've checked my credit report very frequently, and I've checked a lot of different consumer reporting agencies just to make sure that I was hoping that there would not then be a new bank account set up under my name. And so far, there hasn't been. We'll see how that goes. So if you were going to get a credit repair service, then there are quite a few of them that provide services, but there are a few things that you might want to look out for. And so there is a Credit Repair Organizations Act, a law for credit reporting or credit repair agencies, where they have to follow some rules. And so they're required to tell you upfront that they don't really have any extra ability to do anything. A credit repair service can't do anything more than you could do for yourselves, but they can help you because they kind of have streamlined processes where they can help report fraudulent activity. They can help kind of coach you into managing your credit a little more appropriately, those kinds of things. And they cannot advise you to lie or misrepresent information. There are some scams that exist for credit repair companies. One thing that a credit repair service is not allowed to do in the United States, anywhere in the United States, is charge you upfront for credit repair services. So if you ever are looking to hire a credit repair company and they say, yep, pay us this amount of money and we'll get to work, they are not legitimate, and you can feel free to report them to the FTC or the CFPB, but move on. Credit repair agencies have to provide services and then bill you after the fact. So I've seen a number of people who were convinced that a credit repair company was going to help them. They paid up front and then they never heard from that company again. So just be aware of that. They will provide you a written contract. They will give you the right to cancel services, and they cannot ask for payment upfront. If you were going to file for bankruptcy, that would be if you just could not pay your debts. There are two kinds of bankruptcy. One is where they eliminate all of your debts, and then another one was where you put on a payment plan and the judge will order you to pay a certain amount on debts every so often. I generally, hope that people, don't file bankruptcy, and I try to advise people not to if they have a way to make their payments, even if it's maybe calling and renegotiating the debt with some lenders and saying, listen, I can pay this much now, and then I'll pay this amount over the next however many years or something. You can do that, but once you file for bankruptcy, all of your creditors have to stop contacting you, and they have to do everything through the court system. So filing for bankruptcy does help with the nonstop calls, but it will completely end your credit score, and then you'll have to build it back up over about 10 years. It takes quite a bit of work to rebuild after a bankruptcy. So what should I do to build credit? Start by pulling a credit report, check for disputes, inaccuracies, just like I talked about with that client from the internet provider. Check to see if there's something wrong, and if there is something wrong, file a dispute, right? And you can let any of the credit bureaus know, hey, this is inaccurate. I need it removed, and here's my evidence as to why I think it's inaccurate. If you don't see any inaccuracies and your credit report is done correctly, then you want to check your credit score, and you can do that. You can either pay FICO directly for it, which maybe you don't want to do because there are free options that give you a pretty close estimate. If you have a low credit score for some reason, you may know why. It could be because you missed some payments, or it could be because you have a lot of debt or something like that. Then start focusing from top down in terms of those 5 parts of a credit score. Focus on making your payments on time, pay down some of your balances. Don't close any old accounts if they're in good standing, right? Closing an old account that had a collections on it or something like that won't remove the mark that there was a collections account previously. It'll just show that account is closed, which will then lower your average age, but the record of the collections or the default will still be there. So just keep old accounts still open, but don't miss any future payments. If your score is already above 740, you don't really need to do anything. Just keep making your payments on time and keep doing great. If you really, really want to have an 850 perfect credit score, then you can try to keep your revolving accounts, meaning like credit cards or things where you can charge more but then pay it off. That's called a revolving account. You can try to keep those down below 10% utilization. Pay off all your debts if you can. That'd be great, but most people don't have the ability to just do that on a whim. And so pay down your utilization as low as possible. And then you can start creating a plan for how to build your credit for the future, knowing that it might dip a little bit in the short term and then come back higher in the long term. I just also wanted to plug some future workshops. So this is part of the Butte County Library's Reach workshop series. And so if you are interested in personal finance topics, we have quite a few coming up. And so I hope to see you at some of those. There's quite a few coming about talking with kids about money, about filing for taxes as both a business, and then a separate webinar for filing taxes as an individual. If you are a business owner and you want to offer retirement plans or other benefits to your employees, we have a workshop for that. And then also planning for retirement. We're going to cover a lot of different personal finance topics, and planning for retirement is one of those. And how much do I need to have in savings, or how, when do I know that I'm able to retire? That's one as well. And so we'll get to those in the next few months, and we'll do some recorded and some live every Friday. You can go to buttecounty.net/BC Library and see the REACH program there, and see all the upcoming workshops that are coming and when they are. And there's a calendar. You can see there's a number of other workshops from other service providers as well on business needs and job search help and all those other kinds of topics that are useful to people too. So with that, that is the end of the workshop. I appreciate you all being here, and have a great rest of your day. Thanks.